Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. In this video, we're going to be clearing up some of the mystery around taxes. We're going to be talking about what they are and why we pay them, so we have a little bit of a better idea as to what they are.
And how we pay them.
And how we pay them. So let's talk about why we're paying taxes in the first place.
Okay, well the simplest reason is that if we want government, then we have to have government, and then government costs money to have. And then somehow we have to raise the money to pay for the government, and taxes are the way that we choose, to do that.
Okay. So what kinds of things do taxes go into paying for on the government side?
Well, okay, first you have to think about the different types of government.
Okay.
There's the federal government, the United States government based in Washington. So that is for defense and education department and, the various departments that they have. And so the money that we pay in federal income taxes goes to pay for all of those things. The money that we pay in Social Security taxes goes towards the Social Security system that pays people money. Most of it is when they're elderly and retired, but there's also there are benefits in Social Security for people who are disabled, as well as for people where a parent has died, for example.
Okay.
So there are some other purposes of Social Security as well. And then you have state government. Right? So the state of New Jersey, the state of Florida, the state of California, all of their operations have to be run, and they have to raise money to do that, and taxes are the main way that they do that. And then you have cities, major cities. Most of the major cities have their own taxation of some kind. So that's basically what the taxes are for. It's typically those governmental entities at just the different levels. Municipalities, I left those out. Counties.
Yeah.
You know what I mean? So all of those need to raise money from big to small, right?
So what types of taxes are there? What are the types of taxes that we're paying?
Yeah. So there are several different kinds of taxes. The main one in the United States is income taxes. So we earn money, and the more we earn, the more we pay in taxes. So that's what the income tax is about. It's called a progressive tax. And that simply means that the more you make, the more you pay. It also means that the more you make, the higher the rate at which you pay becomes. The rate gets higher. But, sorry?
All proportional.
It's not proportional, actually.
Never mind.
Never mind. If somebody makes $10,000 a year versus $1 million a year, the people at $1 million a year paying roughly 40% in federal income taxes versus the people at 10,000 who pay zero.
Oh, I see.
So the tax rates get higher as your income gets higher also. Okay. Then there are other types of ways that government raises money. For example, a user fee. So for our parks, for example, you could have a user fee for parks or beaches or things like that, where the only people paying for it are the people that are using it.
I see.
And so, you raise money by the people that use it rather than everybody, that is in a municipality or in a state paying for that thing. Governments also get money by borrowing money. They can go out to the debt markets and borrow money. And the United States government, whenever you hear that we have a deficit, the way that gets paid generally is by borrowing money. They go and they issue treasury notes and treasury bonds, and they take in the money they get for selling those to the public, and they use that for the operations of the government. So those are the main ways that governments get money to spend.
Okay. So if we're focused on income taxes, what can be counted as income?
Okay. So income typically consists of some very specific categories, okay? The first one would be your salary. If you have a salary, that would be considered income. The next one would be a bonus. If you have a bonus plus your salary, that's considered income. If you're an hourly person, your hourly wage is considered income. If you are a commissioned salesperson, your commission is considered an income. If you are an entrepreneur, for example, and you have either this isn't a separate thing about setting up a company, but you could have what's called a sub-S corporation, where the money that you earn on net profit there flows through to you as an individual to pay taxes on.
Okay.
You could also have a partnership, and that does pretty much the same thing. You could also have what's called a sole proprietorship, and that it's the same thing. That net profit is considered income to you. So in your tax filing, which you have to do every year with the federal government, okay, all those sources of income consider, and those are the main ones. Yeah. They're all, listed there. You might have some retirement income from a pension, or Social Security, things like that. But for people who are working, those are the main sources of income.
Okay. And now, if you're an independent contractor, I know that's a very common thing to be these days. How would that differ for you if you're not making a salary, you're working for multiple companies?
Yep.
Yeah.
Yep.
How would you keep track
Well,
of that?
the biggest difference there is that when you work for a company and you're an employee of the company, that company becomes responsible for holding back from your pay federal income taxes, state income taxes, local income taxes, Social Security taxes, all the taxes that are due for you. The employer has to pay them. If you're an independent contractor and you're in business for yourself, in effect, you become responsible for paying all of these taxes. So you have to understand somewhat about taxes and what has to be withheld. Be good to have a good accounting advice or tax advice on how to do that, because it's best to make quarterly payments. If you're profitable, you want to make quarterly payments to make sure that you don't get
a giant
penalties and interest plus a big giant amount due at the end of the year kind of thing. So independent contractors, they have their own responsibility for everything is really kind of what it comes down to. Slightly different tax rates on Social Security also.
Okay. So we talked about earned income. What is unearned income?
So unearned income is income that comes to you because you invested money in something and it comes through. So you have interest from a bank, you have dividends from stocks that you own, you have capital gains on stocks that you own, for example. All of those things are considered unearned income, but they are still income.
Income, okay.
Yep.
Great. So what would be the difference between a deduction then and a tax credit?
Okay. So a deduction is something where the Congress has decided that if you pay this kind of money for this kind of an expense, you can take your income up here, whatever that dollar amount is, and you can reduce it by the amount of that expense. And then whatever tax rate you're paying at, you're going to pay it on a lower number.
Okay.
So it's the rate times that amount is the tax savings. So if it's a $1,000 deduction and you're in a 25% tax bracket, you save $250 in taxes with a deduction.
Okay.
Okay? A tax credit is different. You don't take your income and deduct it from that. You take your taxes due and you deduct 100% of that tax credit against the taxes due. So a tax credit is much bigger than a tax deduction. So if after all the other numbers are calculated, if you owe $5,000 in taxes, but you have a $2,000 tax credit, you only owe $3,000 in taxes. So a tax credit's not like a deduction. It's worth far more.
How does one get a tax credit? Where does that come from?
Well, in the law, there are certain things that you can do. A lot of it revolves around, for example, care for children and things of that nature. Okay. You can get a tax credit for that. There are certain kinds of investment things where you can get some kinds of tax credits. So it's rare. A lot of people qualify. A lot of people do not qualify for it. Right.
So now that we've got that covered, how do you actually calculate? Say you want to be prepared to know how much you're going to actually spend in taxes. How would you calculate roughly what you're going to owe?
Okay. Well, the first thing to understand is that this is extremely complicated.
Yeah.
Especially when you get down to what you're allowed to take as a deduction and what you are not allowed to take as a deduction. Okay? Because some of those things are very career specific. You might have a career where an actress, for example, might be able to deduct the cost of having teeth fixed, whereas everybody else in the world can't.
Yeah.
Because for an actress to have good teeth is critical to their job, whereas for most of us, that's not critical to our job.
Yeah.
So what deductions you can take or not take are very, very specific to what you do for a living to a certain degree. And you have other things that impact it, like if you're an independent contractor, what things you can deduct, like a home expense, a home office expense, some of those kinds of things.
Yeah.
Okay? So without getting into what can you deduct or not deduct, because we could probably spend 1,000 hours on that. Here's the basics of it. You take all of those sources of income we were talking about earlier, as well as a few we didn't talk about. You reduce that by something called adjustments to income. So let's take an example for adjustments to income of someone who's an independent contractor. Okay? That person might have their own retirement plan, say like a profit sharing plan, for example. An adjustment to their income would be how much money they put into that profit sharing plan for themselves. So it's a deduction against their income. Another adjustment to income for people who are self-employed, for example, is they can deduct a portion of their FICA tax, their Social Security tax. They can take a portion of that as well, or their medical insurance costs. So those are called adjustments to income.
Okay, because in other cases you might have those things covered by a company.
That's exactly correct. If you were working for a company, those would be expenses of the company typically. So you get down to what's called adjusted gross income. Now you get to what's called itemized deductions. And itemized deductions, there's 4 or 5 really key ones that most people have, and those are contributions to charity, mortgage interest deduction, property taxes that you may pay, and state and local income taxes that you may pay.
Okay.
A couple of others as well, but those are really the big ones. And everybody gets a $25,000 freebie on this, basically.
Okay.
So until what you are paying goes over that, you don't even have to worry about it. You just get $25,000 deducted off automatically. Okay? So you take those itemized deductions, those numbers, and you further reduce your income with that. Okay? Now what you do is you have what's called a tax table, and you look at the tax table for that number and for your filing category, which is like, I'm single, I'm married and I'm filing jointly, I'm married and I'm filing separately, I'm the head of a household. These are all slightly different. You take those and you look to see what the tax is and how to calculate it in these tables for that particular level of income after all those deductions. Okay. Now the really cool thing is if you use a software, it does it for you, so you don't have to go to a tax table. That's very old school,
just like
obviously.
Look it up.
Right. Well, if you've put in what your filing category is, say single, and you've calculated down to this number, it's going to automatically put something there. Now the next question is going to be, do I have any tax credits against that?
Just went over.
Right? Do I have any tax credits? And those would go next. And if you have tax credits, then you can subtract those directly from that tax calculation that you just did. Okay. And you find out the bottom line, what the tax is that you owe. Okay. Now the question is, how much did you pay during the year already? Okay?
And is it different?
Withheld from your salary, or quarterly payments that you made if you own your own business, you're an independent contractor. So, and as you said, is there a difference? And is the difference more or less? So if you didn't withhold enough money, you have to send money off to the federal government or to the state government if this is a state income tax return. The process is relatively simple. I mean, similar, whether it's state or federal. Okay. So, and if it's the other way around, you get a refund. The government owes you money back because you withheld or you paid in too much. And now you're going to get some money back on that. So by April 15th every year, you're supposed to have sent off this thing. You can file for it. You can go on what's called extension, meaning I'm not ready to file the whole thing yet, but this is an estimate of where I'm at. And I've paid more than I needed to, or I'm expecting to get money back when I finally do this. If I haven't paid enough money, I need to pay it then to avoid a penalty.
Oh.
I can go on extension, but I still have to pay the money.
Yeah.
Got to pay the piper. The government wants its money. It's not willing to wait till October 15th. If you're on extension, you can go to October 15th to complete the tax return and then file it with the government. And at that point, if you're due money back, you'll typically get the money within something like 4 weeks or so.
Okay. What are the main forms that people should be filling out?
Okay. For most people whose situations are fairly simple, the federal return is something called a 1040 because most people don't have, for example, more than that $25,000 in itemized deductions.
Yeah.
They may have no adjustments to income. They may just have salary and the itemized deduction $25,000 number, and that's it.
Yeah.
They just calculate taxes. For people who have a situation that's more complicated than that, they're going to fill out a regular 1040 and not well. Not only is that not easy, but that may be attached. That may also have many schedules attached behind it that back up everything that you say. You put money into during the course of the year to get these tax deductions and things. And if you own a business, it's just that much more complicated and more return pieces. For example, if you are a sole proprietor of a business, meaning the name is just the name of the business is just John Doe Consultant, for example.
Okay.
Then you file with your return something called a Schedule C. And that's like a profit and loss statement of that John Doe Consulting business.
So if you're an independent contractor, you would fill out a Schedule C.
Well, generally, unless your independent contractor business is in a corporation. Okay. You could be John Doe Inc. and still be an independent contractor working for various companies. And they're paying money to John Doe Inc. Okay? And if that's the case, so corporations have a different thing. They have something called an 1120. That's their tax return. I know, right? And then the states have their tax return. But the state tax returns typically follow the federal. So it might be the California 1040, the CA 1040, et cetera. Now, some states have no income tax. So you're not going to have a state income tax return if there's no state income tax. Cool. So a partnership, for example, files a Form 1065 if you have a partnership. So that return would say, hey, this person earned this much money from their partnership. So the 1065 then becomes a part of the 1040 because the net income from that is part of that income way back when on the 1040 on the front page. So
you're kind of attaching everything to
It's so as people get more complicated financially, the tax return gets thicker and thicker over time. But for most people, especially younger people, that 1040 is going to be what they're going to end up filing.
Perfect. Let's just briefly touch on property taxes.
Okay.
If there's a way to briefly.
So this is a form of revenue, typically for local municipalities, county governments, that kind of thing. It's kind of rare to have a state that has a property tax, for example. So a property tax, think of it this way. It's an anachronism. It goes back to the time when we were an agrarian society and how much revenue your farming and your cows and everything generated had to do with how much income you generated, basically. So there was a tax on the land.
I see.
Okay, the sheriff of Nottingham, right, going out and going after people for the taxes that they owe on their land. So that's where property taxes came about. And as time moved on and we moved away from that as a society to an industrial-based society, not a land-based society, you have tons of people making a lot of money in other industries where they don't own any land.
Yeah.
And therefore the government created income taxes. And in the early 1900s, an income tax was federally instituted by an amendment of the Constitution. So think of a property tax as something that's paid on the land that you own and whatever buildings have been put on it. They're called improvements, okay? But whatever buildings you put are on it increases the value of the land, and you pay something based upon the value of that land. And this is where property taxation becomes difficult, for example, for older people on fixed incomes, because their land may be going up in value because they've lived there for 50 years, but their incomes are not going up. They're on a fixed income or, a pension and some social security. So property, there's a lot of conflict in taxation generally between older folks who, don't want to pay more in income taxes, property taxes, versus everybody else who is very happy that their properties are going up in value because it means they're wealthier, So property taxes, it's based upon the value of the land and buildings that you own. Okay.
Well, we just covered a lot of ground on that topic, but I hope that you are ready to tackle taxes in whatever form they come in. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.